Hi guys, and welcome to almost our very last session for the semester. I'm sure that probably makes you guys nervous but happy at the same time. So let me just get this off my desk, make some space. Okay, so I have pressed record, so we are recording for this evening, so I'll post whatever we do this evening onto your YouTube tomorrow. As I said in the, let me just turn my video on for a sec. As I said in the posting that I made in your announcements, I'm going to do 2017 paper tonight. I've gone through all of the questions that we've been, that I've already posted for you. I think, what was it, the 2015 paper, and then I think it was a 2018 paper. And I've had a look at the questions that were covered in those papers that I've already uploaded, as well as those other ones, those podcasts that I uploaded. And this paper, this 2017 paper, has got different questions that weren't covered there, because otherwise you end up getting a lot of papers with the same questions over and over again. So I just looked for something slightly different. Although, as you've probably noticed if you have been looking through past papers, there is a pattern to the papers and certain questions that do get asked regularly, kind of like in circulation, because obviously we're testing you on the same work every year, so questions will be similar. But I'll talk about that as we go through the questions as well. Sometimes they ask them in a slightly different manner, or they ask you to calculate some of the amounts that perhaps they gave you a figure in a previous question, and this year they might give you other information that you've got to use to calculate an amount. But they will expect you to be able to do that, because at third year level, you should be able to use all of your prior knowledge across the whole degree that you've been doing, to use that knowledge to work out any missing bits of information that you've got. But generally they're not difficult. You just have to calm down and have a look at the information that they've given you. They will always give you all the information that you need in the question that you are doing. So what you need will always be there. So don't get nervous if you see something that you don't recognize, because that's one of the common complaints we get from students across all the modules after tests or exams, and they say, oh no, the paper wasn't anything like any of the previous papers. So that's never true. The papers are always very similar, but just sometimes they ask the same question but in a different way. Okay, so now I am going to go and share my screen so that we can have a look at and audio and share, so that we can have a look at the papers and then go through the questions. So what I'll do this evening is, because it is an exam paper, obviously it's a 3-hour paper, which is long. So I'll just do whatever we can finish in approximately an hour. Have I got that in the right way? And then I'll stop, and then whatever we don't finish this evening, then I'll carry on and record tomorrow, so that you have got the whole entire paper. And then also, as I'm sure you guys have seen already, I did upload this question paper in your more resources so that you can download it yourself and print it out, or whatever you want to do to practice with it. Because this paper was exam 3 from 2017, which means it was one of the supplementary papers. So it won't be on the past paper library. Usually on the past paper library, on VC Learn, they usually put exam 1, the first paper that was written. So at least now you'll be able to, you will have this paper yourselves as well. Okay, so let's go and have a look at what we've got. So our first question here is a question on factoring, which wasn't in any of the previous 2 papers uploaded, if I remember correctly. So in your textbooks, and please make a note of this, because factoring appears in 2 places in your textbook. If you go to page 128 in your textbooks, that's in Learning Unit 4, you'll see that there's a long discussion on factoring on page 128 and page 129. This is where in your textbook they explain the whole concept of factoring. And then also on page 129, you've got the table where they compare factoring with recourse to factoring without recourse. So this is the only place in the textbook that you'll find this information on factoring in this amount of detail. Then the actual factoring questions are in Learning Unit 5. So if you then go forward, so make a note of page 128 factoring, write that down somewhere at the front of your book or somewhere. And then go to page 163. And here in Learning Unit 5 on current liabilities, this is where you will see factoring discussed in terms of actual questions, in terms of using factoring as a means of short-term finance. So in revision questions in Learning Unit 5, this is where on revision question 6 on page 173, is where you've got a factoring question. Okay. And then on page 163, they also have a short discussion on factoring, but the main discussion is on that previous page that I gave you now, on page 128. So that's important for your revision because you do need to know the background of factoring and how it works and what with recourse and without recourse means, so that you can actually meaningfully complete these questions. Otherwise, you won't know what they're talking about in the question. Okay, so here we've got a company, Trident. They have been approached by a factoring company offering the company a servicing and factor financing agreement. Oh, by the way, also, if you guys want to ask a question, you're welcome to type it in the chat box, or otherwise just speak on your microphone, because I am on a different screen right now, so I can't see the chat box at the same time, although I will be able to jump to it if I need to. So it might actually be easier if you just talk to me if you've got a question. Okay. Trident has been approached by a factoring company, offering the company a servicing and factor financing agreement. Currently, the company pays interest on its overdraft facility of 12% per annum. So that's important information we want to highlight. Its credit losses or bad debts expense is 4.5% of sales. This is where you've got to also pay attention in these questions. Here they've told us it's 4.5% of sales. Sometimes in some questions they say 4.5% of credit sales, and then you've got to work out how much of the total sales is only credit sales, etc. So you have to stay wide awake and read every word and make sure you've understood correctly what they're indicating. All sales are made on credit, so that's also very important. So all sales are made on credit. We need to know that. And we also need to know that they want us to use 365 days in a year. Sometimes they'll put 360, sometimes they'll put 370. They can put whatever they want in the question. You have to use whatever number of days they've given you in the question. It's just another way of testing that you guys are reading correctly, you're paying attention to detail, and that your work is accurate according to the information that you've been given. Then they've given us part of the profit and loss, so sales minus cost of sales and gross profit, just those three figures, and balances of the company's working capital as at the end of the year, inventories, trade receivables, and trade payables. So also, again, you'll notice in this question, they've only given us 1 year's worth of closing balances for our working capital, which is absolutely fine. If they only give you 1 year, then in your formulas, because you know in our formulas for calculating ID and ARD and APD, we are supposed to use the average of inventories and trade receivables, etc. If they've only given you one amount, then you use this amount. obviously can't calculate an average if they haven't given you 2 years worth of information. If they give you 2 years worth of information, the current year and the prior year, then you have to add the two together and divide by 2, because the actual formula for calculating average debtors days, etc., stipulates that we will use the average balance in accounts receivable, etc. Okay. So these are all different things. What I'm trying to explain to you, different things that could be different in the questions depending on who the examiner is and how they wrote up the question. But your ultimate method and your ultimate principles of doing the calculation will always be exactly the same. Then the factoring company has offered to manage the trade receivables. They've suggested the company will benefit if we enter into the agreement as follows. They say that we will reduce the company's average trade receivables collection period to 40 days. Okay, not by 40 days, but to 40 days. Okay, that's also very important. Look at the language. Sometimes they say we'll reduce the collection period by 15 days. Or to 15 days or whatever. So you have to make sure you've read it correctly. A reduction in the bad debts expense to equal 2% of sales, and we will have a saving of 110,000 Rand per annum in our admin expenses. Okay. The factor would make an advance to the company, so our advance would equal 75% of the revised carrying value of the trade receivables. That's the advance that we would receive. And then on that advance, they will charge us an interest rate that is 3.5% higher than what we currently pay on our overdraft facility. So over here, they've told us we are currently paying 12% on the overdraft facility. So on this advance, we will be paying 15.5%. Okay, 3.5% higher than the overdraft. On a recourse basis, they will charge us a commission of 0.85% of sales, and on a non-recourse basis, they will charge us a commission of 1.75% of sales. So just to chat about this quickly here, what recourse and non-recourse means, a recourse basis and the non-recourse basis. That means, does the factor, the factoring company, does the factoring company have recourse to their client, or do they have no recourse to the client? If the factoring company signs the contract on the recourse basis, it means that if the factor can't collect some of the debtors that they have contracted to collect, then they have got recourse to the company, that the company itself will bear the bad debts expense, not the factor, which is why on a recourse basis, the factor's commission is lower than on a non-recourse basis. If the contract is signed on a non-recourse basis, that means that the factoring company, if whatever debts they can't collect is going to be for the expense of the factoring company, they have got no recourse to claim those bad debts back from the company that they're contracting with. Okay, so that's what that means. So let's have a look at what they want us to do. 1.1, calculate the current cash conversion cycle, so our CCC, without factoring. So in other words, just exactly as we are now, what is our cash conversion cycle? Only for 6 marks, but we know what we've got to do for that. We have to calculate, we've got to take IRD plus ARD and subtract APD to get our cash conversion cycle number of days. Please read all instructions very carefully and adhere to them, because you will lose marks if you don't do what you were instructed to do. And sometimes in one question, they might tell you to round some and others to use 2 decimal places. So always follow instructions. So let's go and have a look. We want to calculate our cash conversion cycle. So we need this information here. We need our balances, closing balances of our working capital items, and we need our extract of the company's statement, and we want to double check that they've told us to use 365 days in a year. So inventory days, so usually it would be average inventory days over cost of sales times 365, but we've only got 1 year's worth of inventory, so we're going to use this inventory closing figure that they've given us, 2350, over, and for inventory days we use cost of sales. So average inventory as a proportion of the annual cost of sales figure, and then we take that percentage of 365 days and we get 143 days. So our inventory only turns over on average every 143 days. Then our accounts receivable, we go here and get our trade receivables. It's going to be 1650 over credit sales, and they told us that all sales are credit, so it will be over the 11.5. We work out that percentage and we calculate that percentage of 365 and we get 52 days. So our accounts receivable is collected on average every 52 days throughout the year. So remember, they told us that they promised a reduction in the company's average trade receivables to 40 days. So it's going to go down from 52 days to 40 days if we factor. So that should be where part of our benefit is going to come from. So we add those two together, RD plus ARD, and that gives us our operating cycle. Then if we subtract accounts payable days, that will give us our CCC. Accounts payable, we take our average trade payables as a percentage of also the cost of sales, so 1900 over the 6 million, and then multiply that factor by the 365 and we get 116 days. You must indicate in your answer that you have added those two and subtracted that figure. So on the left-hand side here, again, we've got inventory plus accounts receivable minus accounts payable equals CCC. And then that equals 79 days. Okay, so that's 1.1. We've got those 6 marks. Then for 15 marks, they want us to calculate the net cost or the net benefit that would arise if we took up the factors offer on a without recourse basis. So on a without recourse basis, non-recourse basis, our factoring charge or factoring commission is going to be 1.75% of sales. We must remember to use that. So when we've got to work this out, whether we are going to, what is going to be the net benefit or the net cost, we are in essence working out what are our current costs, and then of our current costs, what costs will we save and what will be extra additional costs in terms of our current situation. So you can construct your answer in any logical way that makes sense to you. But what I do want you to make sure that you do is that you put these descriptions in words of everything that you are doing. Please, you cannot just go and write down numbers and amounts and numbers and formulas all over the page and come up with an amount. And then when I look at that, I've got no idea what you've done or what each of those figures represents or what you were trying to do. In management accounting, which is what we're doing in financial management, it's very important that we explain to the management that we are doing this exercise for what we are doing in each step of every calculation that we do. It's absolutely critical. And in the real life situations, you absolutely have to do that. Otherwise, whatever workings you give to your bosses is going to be meaningless to them when they try and read it. Which is also why we always give conclusions in words, we explain ourselves, etc. Okay, so the way they've done it in this particular method is first at the top over here, this part of the calculation from here to here, we have worked out what saving or extra cost we will have as a result of the investment in trade receivables changing. So our current investment in trade receivables is 1650. So we write that down. The revised trade receivables, remember they told us collections period will be 40 days. So we recalculate total sales. Remember they said all of these sales are credit sales because we're only going to use credit sales for this calculation. Total credit sales for the year multiplied by 40 over 365. And that gives us our revised average amount invested in trade receivables. Then we can see that that amount is going to reduce because we're going from what was at 52 days down to 40 days in our accounts receivable. So a total reduction in the investment of 389,726. And if we multiply that amount by 12%, which is our cost of, we have to fund this investment in trade receivables through our overdraft facility, which costs us 12% per annum. So we will then have a savings, which would be an interest savings, which in other words, we would be paying 46,767 less in interest throughout the year as a result of having to not having to have such a high investment in our trade receivables. So that's the first savings that we've got there. Then they told us that we would have an admin cost saving of 110. So we write down admin cost saving 110. So far, and take note, there's no brackets around that. And I've put the words there, reduction, and I've put the word saving there, saving. So I know that's cash flow in. So when we've got cash flow in, we use no brackets. If I've got a cash flow out, I'm going to put brackets around the amount. So far we've got those two amounts of savings. They've added those two up over there, duplicated. Now I want to go and look what else is going to change. If I factor, what else is going to increase? What else is going to decrease? Okay, so the next one that they've said is that in addition to this 12% overdraft charge on my investment that I've got, they are going to give me an advance equal to 75% of the revised carrying value. So we work out revised carrying value times 75%. And on that advance, they are going to charge me 3.5% more than the 12% that I've already calculated there. So I'm only adding an X, working out the additional 3.5% over here, because I've already worked out 12% on the full investment over here. I've taken the full savings and I've worked out 12% on that. So on the advanced amount, I will be paying not only 12%, but an additional 3.5%. So this here is then additional interest, not the total amount of interest on the advance. And that's cash out because that's an increased cost. Then they said that my where is it? My bad debts, credit losses currently average 4.5% of sales. So that currently is an expense in my business. So remember what we said about with recourse and without recourse. They have asked us here to calculate the benefit on a without recourse basis, which means the factor is going to bear the total cost of any bad debts in this particular debtors book. the company will no longer have a bad debts expense in their books because the factor will be bearing that entire cost because they signed the contract on a without recourse basis. So we work out what total sales for the year times 4.5%. I am going to have a savings of 517,500 because I am now no longer going to have a bad debts expense at all. Then the next thing I'm going to have is I have to work out how much this 1.75% of sales is because I have to pay that as a flat fee to the factor. So again, they told us to use the total annual sales times 1.75%. That is going to be an additional or new expense. So put it in brackets, cost out, the factoring fee. And then I can add up my savings in my overdraft cost because I've got less money invested in my accounts receivable. I've got the admin saving of 110,000 Rand. I have to pay the factor an extra 33,082 Rand in interest, but I'm going to be saving 517,500 in interest, and then I've got a new expense of 201,250, which is the factoring fee. So when I add these plus, plus, minus, plus, minus, I get a net positive figure, which is the net benefit if we factor on a without recourse basis. Okay. So as long as you understand the logic of what it is we're doing in this calculation, you don't have to memorize this exact line by line format for the exam. You must just remember that each item that they mentioned here, that is either a cost or a saving, you need to take into account in your workings, clearly labeling each step as you go along. And then at the end of the day, adding up the net cost or benefit. In this memo, they had an alternative method, which some of you, I prefer, personally, my brain works on this particular method that we're looking at now. It's what I would do if I was doing it on my own. Let's say, if I worked for a company, this is how I would do it. I would say, currently without factoring, this is what my total cost is, which is my current investment in accounts receivable multiplied by the overdraft rate. So this is the interest I'm currently paying. I currently have a bad debts expense and I currently have an admin cost expense. So those three amounts total 825,500. Then if I factored, what would change? My investment in accounts receivables would go to, and again, we work out the 40 over 365, the new investment in accounts receivable. So we say 75% of that, here's my new investment in accounts receivable. 75% would be the advance, which the factor is charging me 3.5% more than the current interest rate. And then in addition to that, the other 25% of my investment in receivables, I am going to only be paying 12% on. So the total interest cost is going to be 184,315 on my investment in accounts receivable. My bad debts expense is now going to be null because that disappears. My admin costs are now null because that's disappeared. And I have an additional cost of the factor fee, which is 11.5 times the 1.75% of the 201,250. So on this side, I'm now going to add up my interest cost and my factor fee. And those two add up to 385,565. And then we can see that my total costs have reduced by 439,935, which is exactly the same answer that we got when we used this method. So it doesn't matter which method or what method you use, as long as you clearly show what you are doing in your workings. And I can make sure that the marker can follow your workings clearly so that we can award you all of the marks. We can't award marks to workings that we can't follow. If I don't understand what you've done, I can't award marks for it, especially if the amounts, your calculations are incorrect, because then it's even more difficult to follow. Okay, did they ask us anything else? Oh yeah, and then they also asked us to discuss 2 disadvantages that they should take into account before making use of a factor. So again, this is just stuff you'll find in the textbooks in your learning unit 4. So take note, this is in the, remember I told you those pages that you need to go and check. On page 128 in Learning Unit 4, this is where this theory comes from, whereas your calculation came from Learning Unit 5. It is a learning objective. Remember, you know what theory to study for theory questions because they tell you that in your learning objectives. So this is straight out of the textbook. 2 disadvantages, 4 marks, so 2 marks per disadvantage described. Okay, anybody got any questions with anything there? Is there anything you want me to go over again, to explain again, or anything that you didn't understand? Everybody okay with question 1? No problems? Cool. Okay, so then let's go and have a look at our question 2. So this is also one that we didn't have in either of the previous 2 papers. It's also in your textbooks. I'll give you the textbook reference in a moment. Okay, so let me just get that. Take my, what am I looking for? Okay, so we are looking for seasonal funding strategy. So this you'll find in your textbook on page 108. And on page 109, the discussion on conservative and aggressive funding strategies. And example 4.4 is the same as this question, as well as question 4.2 on page 111. So that's where in your textbook you'll find this question that we're looking at now. So we've got the Aqua Division has prepared its budget for 2017 and its working capital requirements are summarized below. So this is kind of what happens in a company that is very seasonal. They've got different working capital requirements for different months throughout the year. In other words, their inventory levels can fluctuate quite widely, as well as maybe their payables and their receivables, etc. Okay, so this is what would happen. So if you look over here, they've estimated for each month of the year what they reckon they need to as a total investment in their working capital. So you can see we go from what's the highest here is 8 million is the highest in March. And then we go down to, there we've got 3.3 and the lowest is 3.150. So there's quite a difference between 8 million and 3 million and all the other amounts in between. The division is deciding whether to adopt an aggressive funding strategy or a conservative funding strategy. Short-term funds, which means funds that are going to be borrowed, for instance, either using something like an overdraft or some kind of other either secured or unsecured short-term financing, they reckon they'll be able to borrow at 15.25% per annum. But if they borrow long-term funds, which means something that they will be borrowing for at least 12 months or more, they'll sign a contract to say, I'm borrowing this amount of money for 12 months or longer. If they do that, they have to pay 18.75% per annum for long-term funds. If the division adopts an aggressive funding strategy, explain the approach that will be followed. So we must in words explain and calculate the amount of short-term and long-term financing required to meet the working capital requirement. Okay, the amount. So what rand value do we need to borrow short-term, and what rand value do we need to borrow on a long-term basis? And then also calculate the total average cost of that funding strategy. So there's a lot in that short question that they've asked us for 23 marks. Okay. Aggressive funding strategy. So in your textbooks, you'll find on page 110, you'll find the two calculations. For example, 4.4. In the middle of the page, what the calculation would be if it was a conservative funding strategy, and then below that, the table, what it would be if it was if they did the aggressive funding strategy. So that's what we're going to do. So for an aggressive funding strategy, we've already had a look here, and we've said that the highest amount is 8 million, the lowest amount is 3.150 million. So every single month of the 12 months, at a minimum, we require a permanent funding of 3.150 million. Okay, because that's the least amount of money that I have to borrow in any month. Some months more than that, but no months less than that. So at a minimum, I have to have access to funding of 3.150. So what we do, have a look on the right-hand side here. So the table that we draw up is we make a table of all 12 months. We write down our total amount that we need in each month. Then we do a column for permanent funding, and that is equal to the amount, the lowest amount in any one of the 12 months. That amount is then subtracted from the total for each month. So 4.5 million minus 3.15 million equals 1350. And that's what we call the seasonal funding. So on a seasonal basis, when my funding requirement fluctuates, these are the extra amounts that I will require in these specific months. We add these seasonal amounts up for all 12 months, and we get a total, and we divide that by 12. Please take note that even though there was a month over here that had 0 requirements, in seasonal requirements, obviously in the month that is equal to our minimum permanent amount, we still divide the total by 12. That's important, so remember that. Add up all the months and divide it by 12 to get our average monthly seasonal requirement. So on average, we need an extra 2.045 million every month over and above our 3 million. Okay, so that's the first part of the question, which said, if we adopt aggressive, explain the approach. So the explanation is here underneath. And calculate the amount of short term. We've got that as 3150. And sorry, the other way around, 3150 is going to be our long-term amount, and our short-term amount is going to be the average monthly amount. Okay, calculate short-term and the long-term financing required. So we've done that. this is going, the 3150 is going to be our long term, and the 2045 is going to be the short term funding required. Then they next say also calculate the total average cost of the aggressive funding strategy. So now we've got those two amounts, we can go and calculate what that will cost us to borrow money to cover that working capital. I'll come back to this explanation in a minute. So there's 6 marks for calculating the cost. This was 14 marks. This table was for 14 marks. You can see, guys, that's a super easy 14 marks to get. All you've got to do is know what that table looks like, and you've got 14 marks. Even if you can't remember the calculations, that's still the majority of the marks in this question. So to then calculate our cost of those funds, the cost of the short-term seasonal funding is we take that average monthly amount and we multiply that by the short-term cost or short-term rate, 15.25. We calculate the amount of interest that will cost us. Then the cost of the long-term permanent funds is the 3150. We need to borrow that for the entire 12 months, so that's why it's a long-term section, and we are paying 18.75 for that. So 18.75 times 3150, and we get our long-term interest cost. Then we add the short-term and the long-term cost together, and we get our total cost of the funds for the aggressive funding strategy for the year. So then we have covered also calculate the average monthly cost of the aggressive funding strategy. And then we must go back and check, did we answer everything that 23 marks wanted? Explain the approach. So that is this paragraph here. With the aggressive funding strategy, the Aqua division will borrow as and when the funds are required only. In other words, they won't borrow the total amount that they require for the whole year. The seasonal amounts, they will only borrow when they need them. So they'll borrow between 150,000 and 4.85 million to meet its seasonal funding requirements. And where did those amounts come from? Over here, the lowest they'll borrow from 150,000 to 4.8. That's the lowest and that's the highest in terms of the seasonal amounts. So in any month, they might have to borrow 150,000, and in one particular month, they're going to have to borrow 4.8 million to meet its seasonal. Seasonal funds will be borrowed at the prevailing short-term rate, and the permanent fund requirement of 3150 will be borrowed at the prevailing long-term rate. So there's your explanation. Short and sweet, simple, but it must contain all of the facts. And let's have a look here. There was 1, 2, there were 3 marks allocated to that explanation. And then for 2 marks, explain why it would be riskier for Aqua Division to follow an aggressive seasonal funding strategy compared to a conservative seasonal funding strategy. So if they were following a conservative funding strategy, if you have a look over here, they would have a look and see that our highest requirement is in the month of March for 8 million, and they would borrow that entire 8 million for the full 12 months at the long-term rate. So a conservative funding strategy would cost 8 million times 18.75% in terms of interest cost for the year. And if you compared that cost to this aggressive funding strategy, you'd see that the conservative would be a lot more expensive. But they're saying, so conservative is much more expensive, but why would it be riskier to follow an aggressive funding strategy? The greater risks is in that it may face exposure to short-term interest rate fluctuations. So although at the time of doing our budget, as we are doing here, short-term funds can be borrowed at 15.25% per annum. If throughout the year, like for instance, what happened now in 2023, short-term interest rates changed many times throughout the year and they increased every time. So that means that their original estimate of this 902,000 would end up at the end of the year being a lot more because they were relying on a lot of short-term funding that in the end cost them more than the 15.25%. And then also the other thing that can happen in the market that can change in the marketplace from the beginning of the year when they did this exercise is that funding in the money markets could tighten. In other words, they could face limitations in funding availability. And suddenly, if they approach the banks and in one particular month, they now required 4.8 million, and the banks would say, I'm sorry, but we can't give you that amount at 18.75. We can only give you 3 million at that rate. And if you want more, we can possibly source it, but it's going to cost you a higher interest rate. So those are the risks. You will definitely save money on paper because your total cost will be less than the conservative strategy, but there are greater risks that could affect your costs through the year as the year progressed. Okay, everybody understand that question and happy with that? That's a fairly simple section in your textbook. So again, you go to your textbook. This comes just after the cash conversion cycle calculations. And it starts on page 107, where we then discuss how are we going to fund our cash conversion cycle. And it is important, that question does often come up in exams, and I haven't seen it for a couple of years, so perhaps it will come up this year. I don't know. We also haven't seen factoring questions in a while, so perhaps we'll get a factoring question this year. If you have a look at the last couple of years' papers, they don't often repeat questions from the exact previous year or two. Sometimes they do, sometimes they don't. So it's very dangerous to spot questions. I don't like to even suggest that to students, but you always have to be prepared for any of the questions in the textbook because they could ask us anything. Let me just see how we're doing for time. 45 minutes. Okay, so I think we've got time for another question. So let's have a look at question 3, which is for 30 marks. Yes, and this is also something that we haven't looked at in any of our assignments or previous exam papers that I've posted yet. And this also comes out of Learning Unit 5, Management of Current Liabilities chapter, but it wasn't covered in the assignment. And this is, take that out, the cost of giving up settlement discount. So you'll find this in your textbooks, basically starting from page 146, Management of Current Liabilities. Then on page 147, they discuss accounts payable management. So the theory of this was included in your assignment, but we're now going to do some of the calculations attached to this theory, which wasn't in your assignment. So on page 148, they then discuss credit terms. So when we purchase goods on credit from our suppliers, we've got agreed credit terms with them. Sometimes those credit terms include a settlement discount that our supplier will offer to us if we settle our account within a specific number of days after the end of the month of purchase. So if you have a look at the question here, question 3, the management of Ironman Limited are investigating various means of improving the management of their current liabilities in order to reduce their cash conversion cycle. They've provided you with the following information concerning 5 of their main suppliers. So remember, our suppliers, this falls under accounts payable days. And the longer our accounts payable days are, in other words, the longer we take to pay our accounts payable, the shorter, the fewer number of days our cash conversion cycle is in total, because we've got RD plus ARD minus APD. So in general, a company will want their accounts payable days to be as large as possible while still staying within the agreed credit terms of their supplier, because that's how they will keep their cash conversion cycle reduced to its minimum. But we do have to take into account that if our suppliers offer us a cash discount, so this is a settlement discount for paying early, we've got to weigh up whether it would be beneficial for us to take the discount and pay the account early, or not take the discount and pay the account late in order to minimize our cash conversion cycle. Okay, which means we would then be minimizing the amount that we would be funding using our overdraft rate. Because remember, our cash conversion cycle is funded from our overdraft. That's the assumption that we make. So on page 148 and page 149 over to page 150, and also going through to page 151, that's where you've got all the discussion and calculations of how do we work out the cost if we don't take the discount, and then compare that to the cost if we do take the discount, and then we can then decide supplier by supplier which suppliers we're going to pay early and which suppliers we are going to pay in the normal credit terms, so that we are always ensuring that we are minimizing our costs. While at the same time minimize the length of our cash conversion cycle. So here we've got 5 suppliers. These are the settlement discount percentages that they've offered us. And this is the number of days in which we have to pay them in order to be able to deduct that settlement discount from our payment. So this means we've got to pay them within 15 days, usually of the end of the month. So if we made a purchase in January, we have to pay that, all our January purchases, we have to pay by the 15th of February in order to be able to take this discount. The normal credit days is in this column over here. So if we don't take the discount, we're allowed to wait 45 days and then pay the account and still not be in trouble with our supplier. So the question says calculate the cost of giving up the cash discount for each supplier. You'll see that they have underlined the cost, because if you go and have a look in your textbooks on page 149, you'll see that there are 2 formulas there. The first one is the cost of giving up the cash discount equals D over 1 minus D times 365 over N. But below that, we've got another formula, the approximate cost of giving up cash discount. And that formula is just D times 365 over N. There are 2 different formulas. The first one is the cost of giving up the discount. The second one is the approximate cost of giving up the discount. You have to memorize both of these because they are not on your formula sheet. And you have to use the formula that the question asks you for, because if you don't use the correct formula, you can't get all of the marks. Okay? So just be very careful of that. You have to memorize both formulas because they could say calculate the approximate cost, or they could say calculate the cost. And then you must know which formula to use. So here's our formula that we must use, which is the cost of giving up the discount. So D, which is the discount, 1.75 over 1 minus D, so 1 minus 1.75%. And we decimalize it, if that's the correct English, multiplied by 365 over N. And N is equal to the number of days that we are what's the word? The number of days that we are, the extra number of days. So we should have paid within 45 days. We're going to pay early in 15 days, which means I am paying 30 days early. So N is the number of days that I am, that sentence sounds awkward, that I am paying early. Okay, so 45 minus 15. I could have taken an extra 30 days to pay, but instead I'm going to pay within 15 days in order to get that 1.75%. So we're trying to work out, is it worth it to get the 1.75 or not? So you do that exact same formula for each of these 5. You'll get a percentage, which is what we have worked out here is the cost of not taking the discount, the cost of foregoing the discount, or the cost of giving up the discount. All those words mean the same thing, which means that if I give up the discount, if I don't take the discount, my cost will be 21.67% per annum. I know that if I do take the discount, in other words, if I pay early, if I pay 30 days early and I take the discount, that will cost me 22.5%. Because if I'm going to pay the account early, that means I'm going to have to withdraw funds out of my bank account to pay that account early, and that's going to cost me 22.5%. So then we've got to have a look at the cost of not taking the discount is 22.5. Sorry, the cost of not taking the discount is 21.67. And if I take the discount, the cost is going to be 22.5. So obviously the lower cost is if I give up the discount, if I don't take the discount, my cost is 21.67. So that means I should not take the discount. I should forfeit the discount, because then my cost is going to be 21.67 as opposed to 22.5 if I do take the discount. So you always pick the one that's the lower cost. Then the second one, it was 93.59, so that's obviously way more than 22.5. So it's only going to cost me 22.5% if I do take the discount. So for the second supplier, I'm definitely going to take the discount because that cost is lower. I'm also definitely going to take the discount for the third and the fourth suppliers, because there my cost is less if I take the discount and I take the money out of my overdraft. But for my fifth supplier, I'm going to take the discount, because if I don't take the discount, my cost of not taking the discount is going to be 5.1%, whereas if I take the discount, my cost is going to be 22.5%. So there again, I'm going to not take the discount. So this third 3.2, where are we here? So 3.1 is calculate the cost of giving up, and then 3.2 said you had to determine whether the company should forfeit or take the discount for each of those banks. So you had to say forfeit the discount or borrow the funds and take the discount. Okay. So just practice with those you've got. I've told you the section in the textbook to use for that question, and practice with that. particularly practice getting this decision correct, because you'll see that's 5 marks. If you understand it incorrectly, you're going to lose 5 marks by that. And then 3.3 says, if the management are able to negotiate with supplier A and they receive an additional 0.25% discount. So in other words, they have increased their settlement discount from 1.75 to 2%. Will we change our decision? So you then have to just recalculate the cost of not taking the discount, which now is going to be 24.83%. It was 21.67, which was less than the cost of taking the discount. But now, if I increase my, If I increase my amount of discount available, the cost of not taking the discount is now higher than the cost of taking the discount. So I should borrow the funds and take the discount, because if I don't take the discount, my cost is going to be 24%. 24.8%, as opposed to a cost of 22.5% if I do take the discount. So again, there's all the marks for the calculation, and there are 2 marks for saying you should borrow the funds and take the discount, and always give a reason, because this is going to be cheaper than forfeiting the discount, or whatever you describe in your own words. And then 3.4 is explain the meaning of the term accruals to management, and advise as to when the company would be justified in increasing accruals. So we know that accruals, the journal entry for creating accrual is to debit an expense account and credit the liability accruals. And we know that all short-term liabilities are ways of generating short-term funding. So this is what they're talking about here. So in your textbooks again, you will find the discussion on accruals on page 152, page 152. There's the paragraph on accruals, and you'll see that that paragraph in the textbook is basically exactly what they have written here on the memo. So it was for 5 marks, 3 marks for the explanation of what an accrual is. What did they say? Explain the term accrual. So 3 marks for explaining the term accruals, and then 2 marks for saying when a company is justified in using accruals. Remember, that was the second part of the question. So accruals are recurring short-term liabilities for operational expenses that do not relate to the purchase of inventories. In real life, you'll see they often do relate to the purchase of inventories, but anyway, this is what the text says. And it's just another source of spontaneous short-term financing, because an accrual is a liability for purchases and services rendered to the company for which payment still has to be made. Accruals are not supported by an invoice. That's the difference between a true accounts payable and an accrual. At the end of the month, when we've processed all of our accounts payable invoices into our system, we'll have a total for our accounts payable in our system. But then we might have lots of delivery notes for services or goods that were delivered to us or that we received, but we haven't yet received the invoice. And that is what we then accrue. We debit that expense account and credit accrued expenses. The liability account accrued expenses, just to make sure that we are taking into account in that particular time period in our financial accounting all expenses that match up with that specific time period. That's the real purpose of accruing expenses that we haven't yet received an invoice for. Sometimes, if you haven't received the invoice, you have to estimate the cost based on past experience. For instance, your electricity and water bill, your municipal bill is never received by the end of the month. So you've got to estimate what your electricity and water usage was for the month, so that you can accrue that expense while you wait for the municipality to send you your invoice, which will only arrive the following month. Accruals can include liabilities for salaries and wages, because again, remember, salaries and wages, we often pay in arrears, but we've incurred the cost in the month of January, but we're only going to pay the wages at the end of the first week of February, or the salary, if it's paid in arrears, will only be paid at the end. Whatever the services we received in January, will only pay at the end of February. Utilities, rent and rates, etc., all kinds of different expenses could be accrued. Okay, so that's explained in the 3 marks what an accrual is. You'll see there's more than 3 marks available there, but you just have to give 3 valid points. And then when is a company justified in using accruals for 2 marks? Many companies make optimal use of accruals. In other words, they're very strict about making sure they accrue for all expenses that were incurred. But financial managers are only justified in increasing them. In other words, remember over here it says accruals are usually estimated based on past experience. Financial managers are only justified in increasing them if there has been a corresponding rise in the level of the activity of the company. So let's say the past 3 months, your electricity and water bill was 20,000 Rand. But now in this current month that you're going to do the accrual for, production doubled. Only then are you justified in accruing 30,000 Rand for your water and electricity bill, because the activity level of the company did increase. Or, for instance, there might have been an expansion of operations. So for some reason, your consumption of that expense legitimately increased, and that's your only justification for legitimately increasing the Rand value that you are going to accrue versus the Rand value for that utility that you usually accrue based on estimates. I hope that explains it. I hope you guys have understood that. Okay, guys, so I'm going to stop the session here because we've just gone over an hour. And then the last, I think this goes up to 7 questions. Yeah, so then from question 4, I will record for you tomorrow and then post that for you when I've had the chance to record it as well. And then in the meantime, what we've recorded tonight, I will post that video for you tomorrow, the recording for you guys tomorrow. Okie dokie. So hopefully that has been a nice explanation of some questions that we haven't covered before, that you guys are now familiar with, and it will then further help you in your exam revision. So remember also, guys, absolutely anything, I'm waiting for questions for you guys as you're busy with your revision. Anything that you don't understand, how they worked it out in the textbook, how did they get an amount, why did they do something, what's my calculation for getting to a specific amount, then send me a message and I will definitely help you to the best of my ability. Okay, guys, thank you very much for popping in and taking part. And then we've got one more collab session next week on Wednesday, and that will be our last one for the semester. So any questions you want, let me know before Wednesday. Okay, thanks guys. Chat you next week. Bye guys.